Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby and today we're very lucky to be joined by Ben Clark from TMS Capital for an opportunity he believes the market is getting wrong right now. Thank you so much for joining us, Ben. Excited for this discussion today.
Thanks, Ali. Thanks for having me.
What area of the market do you think deserves some more love?
Well, maybe not love, maybe some dating. It should start off. I think is infrastructure. It's been really out of favour this year, and I think we all know why. Like when rates go up as hard as they have, it depresses asset prices, and infrastructure ultimately are assets. And we've seen some real pressure on property trusts, infrastructure, but I think as we're getting very close or we're at the peak of interest rates, this is an area investors should start to look at again, because it was a fantastic performing area for many years before 2023. And I'm pretty confident it will start to resume that. And we're seeing a lot of these stocks are at 12-month lows.
What's the consensus view here on infrastructure?
Consensus is they do it tough. Infrastructure companies typically have fairly high levels of debt, but they have very predictable cash flows that can service that debt. So I think there's two parts to it. The first is rising interest rates, you've got rising debt costs. So the interest cost or interest expense starts to eat into your cash flows, which equals lower profit. And secondly, as we said at the start, the assets potentially in a 4.35% interest rate environment are worth less than they were 12 months ago. So I think that's kind of the consensus view on the area at the moment.
Why the opportunity today then if interest rates are, lowering the value of those assets?
Well, I think the opportunity is when I listen to managers in private markets, so they're owning assets in private hands, not on public markets, they don't necessarily view the current cash rate as the interest rate that you should be valuing an asset at. They would, if they're going to own something for 30, 40, 50 years, which they typically tend to think, they will think, what's our interest rate expectation over that period of time? And that probably actually hasn't changed that much from what it was 18 months ago when the RBA kicked off. It might be 3.5% or something like that. You would also look at the way that those funds or assets, there's some criticism around it, but they haven't nearly marked down the value of those assets the way that the share market has. So to me, there's a gulf that's opened up there between what the patient long-term investors value at versus what short-term markets can value these assets at. So I think that's one reason. The second is you've got to remember, it's not like, say, Transurban's interest cost has gone up in the last year significantly. They will have rolling pools of debt that might be for 10 or 15 years that, yes, as they come to refinance those pools of debt, their interest costs will move higher, but it hasn't happened straight away. And if we do start to see it, 2024, 2025, a bit of a normalisation back down in rates, you might actually find that what they're rolling those pools of debt back onto isn't nearly as bad as it is today.
We saw Sydney Airport being taken out by M&A during COVID-19 when it was at an all-time high, and it was also shut at that point in time.
Incredible, yeah.
What do you think could be the next great M&A opportunity within infrastructure?
That actually goes back to what I was talking about before. The airport was shut and it was showing no signs of reopening for at least a couple of years. But private capital didn't look at that short-term thing and think, oh, we've got to pay less for it. They paid an all-time high for that stock. And that goes back to taking a different viewpoint to what the public markets can tend to take. We have faced a shrinking number of A-grade asset owners on the Australian Stock Exchange. I would say there's probably 5 or less in that basket now, and it's been because of M&A. Transurban, I think, would be a top candidate. There's a big industry super fund that's the largest shareholder of those assets that has shown a willingness to take assets private. APA is another one. And a third one, I think, is Auckland Airport, where there's been a sell down by some of the natural owners. Because the other thing you've got to remember, Ali, is although interest expenses will go up conceivably over the next 2 or 3 years, the revenues these assets are generating has also gone up. Transurban's tolls are tied to inflation. For APA, 85% of its revenue is linked to inflation, and it's not going to come back down. So revenue for a lot of these asset players has actually been reset higher and will now probably work its way up at a more normal pace from that higher level. So it's not like it's just a cost thing that's eaten into them, revenue has also benefited from this period as well.
Okay, well, thank you so much for coming on the pitch today. It was awesome to have you on the show.
Thanks, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.